Hello everyone, welcome to our Money Chat series. I'm Nova Lui, Head of Investors Advisory RHB Bank, and together with me I have Suprit, Executive Director and Head of Southeast Asia Fund from JP Morgan Asset Management Singapore. Thank you very much for joining us, Suprit.
Thank you for having me, Nova, and hello everyone. It's a pleasure to be here.
Suprit, quickly to address the elephant in the room, Chinese equity market has literally jumped on 16 March. For instance, Hang Seng Tech Index was up by 22%. Hong Kong listed China Stock Index HSCI was up by 12.5%, and the China Onshore Index represented by CSI 300 was up by 4.32% in a single day. That is a really quick booster in the equity market recently. Can you quickly share with our client what has driven the sudden jump in the China equity market?
Thanks for that question. I think it's a mind-boggling performance this week, but it's on the back of a very sharp correction in the Chinese stock markets also. So actually the events that you just spoke about, Noah, reminded me of a revered investor, and he quoted something like this, which goes like, bull markets are born in extreme pessimism, they grow in skepticism, they mature in optimism, and die in euphoria. The events leading up to the markets this week were actually in extreme pessimism just before the 15th, which is when 16th, which is when the markets rebounded sharply. There was extreme pessimism on account of a number of factors. So the factors were geopolitics, obviously what's going on in Ukraine and Russia. There were issues around COVID lockdown in several provinces in China and the impact of that on the economy, and also around regulations, particularly on some large cap Chinese technology companies. So a combination of that led to prices of Chinese stocks getting dislocated from the fundamentals of Chinese stocks over the long term. Now, these dislocations, where the fundamentals are stronger than the prices, have happened in the past. It's not for the first time. Chinese equities tend to be volatile. Equities as an asset class is volatile. Chinese equities tend to be volatile. They have a very strong return profile, but it comes along with its level of volatility. But to answer your question, the sharp rebound was because these dislocations were very sharp before that because of the stock prices correcting. And of course, there were some announcements made, which we can speak about later as well.
Okay. So the Chinese government has cracked down on major companies in China, especially the technology sector, which is still ongoing even until recently. Meituan has even asked to reduce its delivery platform price, and Tencent is under investigation for potential money laundering. So recently, Chinese government has announced its support for the market. Do you think that this means putting an end to the crackdown on the China technology sector?
I think it's important to just take a step back and look at the purpose of these regulations. The idea around putting these regulations, in our opinion, are logical, they're targeted, and they're consistent. Because the real objective here is to set a fair and a level playing field for innovation. It's to avoid monopolistic practices, it's to avoid unfair practices which hurts customers, and to encourage innovation across the industry too. So, in our opinion, while the pace of these regulatory changes was surprising last year, they've actually done what West has already done, which is why you see big tech in the West also come under crosshairs of the regulators too. To answer your question, first of all, we don't think that the regulatory actions are over yet, but on the margin, since the market is now aware of what kind of regulatory changes are coming, the response that we saw to those announcements last year, which was as a result of surprise that the market felt, is unlikely to be as sharp as these regulatory changes come through. Remember, these changes are to set in place long-term sustainable fair ground for companies to thrive and to do and to innovate. The last thing that you want is just one or two large companies to dominate the field of technology. And as asset managers, we also like in our active approach to see medium-sized companies get the opportunity to innovate and become larger through that innovation, rather than just seeing one or two companies dominate the technology sector. So going into next year, we believe that the government will continue to focus on its long-term objective of common prosperity, reducing inequality, and to that effect, if there are any regulatory changes that need to be made, those will be made. So the simple answer to your question is there are likely to be more regulations, but the market reaction hopefully wouldn't be as sharp as it was through the course of the last year.
Moving on to another sector that a lot of our investors are also worried about, the property sector. There are a lot of concern on the property sector in China. However, Chinese developer bond jump and stock surge after Beijing called for more property industry support. My first question is, do you see a risk of industry-wide collapse in the property sector? And secondly, if there is a chance of, is there a chance for contagion effect to other sectors, such as the financial sector?
Don't think there'll be an industry-wide collapse. There could be certain companies which may not survive, but I think it's important to recognize why this is happening. Clearly, towards the ambition of common prosperity and reducing inequality, real estate sector is being de-emphasized. You can't meet your objective of reducing inequality if housing becomes unaffordable. You can't have common prosperity when people can't afford a roof on over their heads. To that extent, there will be slowdown in the sector, which could lead to stress in some companies. But in our opinion, the Chinese governments will ensure that if there are defaults, there'll be orderly defaults, not leading to the contagion that you've spoken about. So those orderly defaults could hurt the specific bondholders, but the cascading effect of that is unlikely to happen in the broader economy, in our opinion.
COVID-19. Malaysia is gradually transiting into endemic. However, China continues to maintain its zero COVID policy. What is happening? Do you see an end to this where China will eventually start adopting to live with COVID-19?
The central objective is to essentially protect the most vulnerable, right? And as we've seen in some of the other countries which have managed to open up their economies, you need to reach a stage of having vaccinated most of your population, as well as having achieved a rate of a combination of herd immunity and a high rate of vaccination. And as we've seen with other countries like the US, Europe, and closer home in Asia, in countries such as India, Southeast Asia, when you feel confident that your most vulnerable parts of your population are now protected either through vaccines or through a combination of vaccines and herd immunity, you can then afford to open up your economy. To us, it's just a matter of when, not a question of if the Chinese economy opens up again. It's just a function of Chinese authorities finding that balance or equilibrium of vaccinations and herd immunity, which leads them to a situation where they can find a way to exit this zero COVID policy. And just like many economies across the world, which have reconciled to the endemic state, will reconcile to the endemic state. So instead of living in fear of the virus, living with the virus with minimal fatalities and minimal hospitalizations. So once again, I want to reiterate, while right now they're in that policy of locking some of the provinces down, to us, it's just a matter of time, not a question of if, when they open up.
Jumping to the Russia-Ukraine war, China is caught in between after declaring its friendship with Russia has no limit. Russia has also asked China's military support in Ukraine. This has somehow triggered the Western's allies, threatening to potentially sanction China. Do you think China's sanction will happen?
I think it's important to acknowledge that never say never. So it's not zero probability event in our opinion, but it's a very low probability event in our opinion. But it's natural for us to think like this because, as human beings, we're hardwired to think a little negatively when we're faced with situations such as the tough situation that we find the world in right now. But I think you have to understand that the developed Western world is right now grappling with certain issues. High energy prices, whether it's oil and gas, high food prices, all of that leading to high inflation. So essentially, While the developed world is putting sanctions on Russia, they're also feeling the pinch because their consumers, their population, are paying a higher energy bill and certainly a higher food bill too. In that situation, it's to us the probability is very low that they will do this with another major trading partner, and China is actually a bigger trading partner for many of the Western countries, which then leads to another set of supply side shortages and leads to another round of hyperinflation, which again puts the stress on the population of these Western countries. So it's not in the interest of the Western developed economies to do this. Let's come to China. I think China is also far more embedded into the Western economies than Russia was. So even when you look at it from China's standpoint, they would also stand to lose if the sanctions were put in. So you've got a situation where it's a lose-lose situation. And therefore, I said that in our base case is the probability of sanctions is extremely low. In the unlikely event that the sanctions do come through, then the events that have taken place over the last couple of weeks of high volatility, please expect that. But again, I want to reiterate, it's not our base case. In our opinion, the probability of sanctions on China is extremely low.
Okay, thanks for all your sharing so far. So in nutshell, what is JP Morgan's view on Chinese equity market in medium to long term? Do you see currently as a very attractive entry point for our investor into the Chinese equity market?
It's certainly attractive, Noah, but no one knows for sure if it's the bottom or whether the 15th of March was the bottom. Nobody can predict where the bottom is. But if you look at the previous corrections that have taken place in China, there have been corrections or sharp corrections in the years like 2018 because of trade war fears. There was 2015 because of concerns around potential shadow banking issues. And 2011 because European debt crisis was playing out in continental Europe. In each of those time periods, the correction in the Chinese markets was quite sharp, actually very similar to the sharp correction that we've seen in Chinese equities over the last 1 year. But very often, if investors do hold or use that as an opportunity to build positions, often 6 months later, the portfolios have delivered gratification in client portfolios. So we can't predict whether the market is bottom now or whether the market's going to bottom in the next few months. But for long-term investors, we do believe that there are quality and growth opportunities within China in certain sectors. So don't know if the bottom's been made, but quite optimistic about long-term prospects of certain Chinese companies.
That comes to the last question for you today. So what is your advice for our investors?
I think it's very important to stick to one's asset allocation and stay diversified. You don't have to have a favorite market or a favorite geography. Please work with your investment advisor to find out your risk tolerance and build a portfolio which is in line, or the asset allocation is in line with those with that risk profile. Very often, having a diversified portfolio allows you to meet your financial objectives in a lot less volatile way rather than betting on one single market. So my advice to investors is to stay diversified and to stay invested and not necessarily just look at the volatility and get spooked by the volatility also.
To all RHB Bank's investors, this is a list of China funds available on our platform and also other related funds which have significant exposure in the China market. We encourage clients to have a well-diversified portfolio. Hence, you may scan the QR code below to get more ideas of other funds that you may consider in your portfolio. RHB Asset Management continue to maintain its constructive view on China in long run. Despite recent rebound in the China equity market, away from its peak in March last year, the China indices are still down by a range between 20 to 50%. The equity market is very volatile and it's important to keep yourself updated on the recent news and view from our experts in order to make informed investment decisions. You may follow our RHB Bank's official Facebook to view other Money Chat series. And do engage our relationship manager to conduct a portfolio review on your investment to ensure your investment portfolio is well diversified and rebalanced in a well-informed and timely manner. Hope to see you soon in the next Money Chat series. Thank you again, Suprit, for joining our Money Chat.